On June 19, 2026, Wall Street witnessed the biggest single-day peace rally in its modern history. Tech stocks surged, risk assets celebrated, and billions of dollars flooded back into the global financial system. Yet, at that exact same moment, the world's premier digital asset did something completely irrational. It crashed. For years, you've been told that Bitcoin is a pure risk-on asset, that it hitches a ride on the back of stock market rallies. But this week, that correlation didn't just bend. It completely shattered, exposing a massive, hidden capital trap that left retail traders completely wiped out. Welcome to Block Docs, where we strip away the noise to expose the raw truth of crypto and global finance. Hit subscribe to track the money with us, and let's get straight to the story. To understand the mechanics of this market anomaly, we have to look at what occurred in Switzerland on June 19th. Following 3 months of a crippling naval blockade in the Strait of Hormuz that sent global energy costs through the roof, diplomats officially signed a historic geopolitical peace agreement. The risk of a broader global conflict evaporated in an afternoon. The reaction in traditional markets was pure euphoria. WTI crude oil plummeted 4.2% to $71.50 a barrel as supply fears vanished. With energy inflation risks subsiding, institutional money manager desks rushed back into equities. The tech-heavy Nasdaq soared by 3.1%, registering its best single-day performance of the year, while the benchmark S&P 500 added 1.7%. By all conventional financial logic, Bitcoin should have led the charge. Instead, it decoupled entirely. As global stocks experienced a historic influx of capital, Bitcoin fell 3.8% intraday, breaking beneath critical macro support to settle at an agonizing $63,908. Retail speculators were left asking a single, urgent question: why is the ultimate currency of the future failing during a global market celebration? The answer lies in a concept that 99% of retail investors completely misunderstand: Safe-Haven Geopolitical Premium. For the past 90 days, while the mainstream media pointed to spot ETF inflows as the sole driver of Bitcoin's price stability, a highly sophisticated cohort of sovereign wealth funds and macro hedge funds were treating Bitcoin exactly like digital gold. When the Strait of Hormuz was shut down, threatening international trade, big capital didn't just buy physical gold. They bought Bitcoin to hedge against a systemic collapse of the banking system. Bitcoin had quietly accumulated a massive premium based purely on war risk. It wasn't rallying because of tech stock adoption. It was rallying because the world was terrified. The moment the peace treaty ink dried in Switzerland on June 19th, that entire thesis inverted within minutes. The geopolitical risk premium was instantly erased. Institutional asset allocators faced a stark reality. They no longer needed to hide out in non-yielding defensive safe havens. They needed to capture growth. What followed was a brutal, programmatic capital rotation. Algorithms across major quantitative funds executed automated sell orders on safe havens. Gold dropped $45 an ounce intraday. Bitcoin was dumped simultaneously into the liquid order books, providing the raw cash necessary to fuel the massive tech stock buying frenzy. Bitcoin wasn't weak. It was simply treated as a liquid ATM by the largest financial institutions on Earth. Compounding this asset rotation was the unresolved ghost of the Federal Reserve meeting from 48 hours prior. On June 17th, Fed Chairman Kevin Warsh had shocked Wall Street by dismantling forward guidance. While equity traders ignored this because of the peace deal, crypto markets could not. The US dollar index remained stubbornly strong, at 104.8. Because the Fed signaled that interest rates would remain higher for longer, global dollar liquidity was tightening behind the scenes. The digital asset ecosystem was starved of fresh capital. When spot Bitcoin ETFs registered a massive $111 million cash outflow following Warsh's speech, the order books became incredibly thin. The sudden geopolitical sell-off hit an empty market, forcing a vertical cascade. As the price breached $65,000, the structural trap snapped shut. Retail speculators who had gone long, anticipating a stock-driven breakout, were caught completely off guard. Their stop losses triggered automatically, feeding the sell-side algorithms. The Crypto Fear and Greed Index collapsed down to a staggering multi-year low of 15, a metric of absolute psychological terror. But while retail portfolios were entering a state of total panic, something extraordinary was happening on the blockchain ledger. The public saw a market failure, but smart money saw a generational pricing mismatch. During this exact 48-hour panic window, long-term holder whale wallet addresses silently absorbed over 125,000 BTC directly from the liquid market supply. They weren't panicking. They were executing a coordinated liquidity sweep. They understood that the fundamental structural scarcity of Bitcoin had not changed. The macro whales used the peace-induced capital rotation as a smokescreen to strip retail investors of their spot supply at prices that will likely never be seen again in this cycle. The Great Divergence of June 2026 exposes the single greatest flaw in the average investor's mindset. If you view Bitcoin purely through the lens of short-term stock correlation, you will always become exit liquidity for Wall Street. Bitcoin is not a tech stock proxy. It is a parallel financial architecture. When macro capital rotates to chase equity growth, it creates sharp, artificial volatility in digital assets, volatility that is weaponized to shake out weak hands. To survive this cycle, you must look beneath the surface. You must monitor macro correlations, track capital rotation metrics, and recognize that a decoupling event is usually the final accumulation phase before a massive upward expansion. Was this decoupling a warning sign of a prolonged crypto correction? Or did the whales just execute the cleanest shakeout in history? Let me know your technical assessment in the comments below.